Preparing for investment banking at Piper Sandler interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in investment banking at Piper Sandler? I am drawn to Piper Sandler because it combines meaningful middle-market advisory work with strong sector expertise and a collaborative culture. The firm's platform appears especially attractive for gaining early responsibility, since lean teams often allow analysts to work closely with senior bankers and clients. I also like the opportunity to advise growing companies on strategic decisions rather than focusing only on large, highly standardized transactions. My goal is to build rigorous technical skills while becoming a dependable execution team member. While answering, connect your interest in advisory work to Piper Sandler's middle market focus, sector expertise, entrepreneurial culture, and meaningful client exposure. Demonstrate specific research rather than relying on generic prestige or compensation motivations. Question 2. Walk me through your resume. I would organize my resume around 3 themes: analytical preparation, interest in companies, and teamwork. My coursework and finance experience gave me a foundation in accounting, valuation, and financial modeling, while internships taught me how to analyze information accurately under deadlines. I also pursued leadership opportunities that required communicating with different personalities and owning outcomes. Those experiences brought me toward investment banking, where I can combine quantitative analysis with client service and contribute to transaction execution. Make sure to cover your educational choices, relevant finance experiences, evidence of analytical ability, leadership, and the logical progression toward banking. Keep the narrative concise, chronological, and connected to Piper Sandler's client-focused advisory environment. Question 3. Tell me about a recent Piper Sandler transaction or sector you find interesting. I would discuss a recent Piper Sandler transaction in a sector such as healthcare, technology, or financial services, after verifying the latest details. I would explain who the buyer and seller were, the strategic rationale, the valuation context, and why Piper Sandler was well positioned to advise. For example, a transaction involving a specialized healthcare business might reflect buyers' willingness to pay for recurring revenue and defensible capabilities. I would also identify one risk to the thesis. In your answer, name a specific announced transaction or Piper Sandler coverage area, explain the strategic rationale, and discuss valuation or market context. Show independent research and avoid merely repeating the firm's press release. Question 4. Walk me through a discounted cash flow valuation. A DCF values a company based on the present value of its expected future unlevered free cash flows. I forecast revenue, margins, taxes, capital expenditures, and working capital to calculate cash flow, then discount those amounts using WACC. I estimate terminal value using either a perpetuity growth or exit multiple method, discount it back, and add it to forecast cash flows. Finally, I subtract debt and add cash to reach equity value, testing sensitivity to WACC and growth. Be sure to mention unlevered free cash flow, explicit forecast years, WACC, terminal value, present value, and enterprise to equity value reconciliation. Explain key assumptions and why sensitivity analysis is essential. Question 5. How do you calculate enterprise value from equity value? Enterprise value represents the value attributable to all operating capital providers, while equity value belongs only to common shareholders. Starting with equity value, I add total debt, preferred stock, and non-controlling interests, then subtract cash and cash-like investments. The exact bridge can require judgment, such as deciding whether to include leases, pension deficits, or minority investments. In an M&A analysis, I would use consistent definitions across the target, precedent transactions, and comparable companies. In your answer, distinguish equity value from enterprise value and cover debt, preferred stock, non-controlling interests, cash, and equity investments where relevant. Clarify that the bridge depends on transaction and data definitions. Question 6. How do the three financial statements link together? Net income begins on the income statement and flows into retained earnings on the balance sheet. On the cash flow statement, I start with net income, add non-cash expenses such as depreciation, and adjust for working capital movements to calculate operating cash flow. Investing and financing activities then explain additional cash changes, with ending cash matching the balance sheet. For example, depreciation lowers earnings but is added back in cash flow while reducing the asset balance. Focus on net income flowing through the income statement, retained earnings, and operating cash flow. Explain how balance sheet changes reconcile cash, and use a simple transaction or depreciation example to demonstrate fluency. Question 7. What happens to the financial statements when depreciation increases by $10? Assuming a 25% tax rate, a $10 increase in depreciation lowers pre-tax income by $10 and net income by $7.50. On the cash flow statement, I add back the full $10 non-cash expense, so cash increases by $2.50 through lower taxes. On the balance sheet, PP&E declines by $10, cash rises by $2.50, and retained earnings falls by $7.50, keeping assets equal to liabilities plus equity. Without taxes, cash would be unchanged. Make sure to state the tax assumption, trace effects through all three statements, and distinguish cash taxes from accounting expense. Interviewers want mechanical accuracy and awareness that the answer changes with tax deductibility. Question 8. What is the difference between an accretion, dilution analysis and a DCF? A DCF estimates a company's standalone intrinsic value by discounting future cash flows. An accretion, dilution analysis instead asks how a proposed acquisition affects the buyer's earnings per share. It incorporates purchase price, financing mix, interest expense, new shares, taxes, synergies, and purchase accounting adjustments. Therefore, a deal can be accretive but still destroy value if the buyer overpays, or dilutive initially but strategically attractive if long-term cash flows and synergies justify the investment. Explain that accretion, dilution evaluates transaction impact on buyer EPS, whereas DCF estimates standalone intrinsic value. Cover financing mix, purchase accounting, synergies, and the different decisions each analysis supports. Question 9. How would you value a company with negative EBITDA? If EBITDA is negative, I would avoid applying an EBITDA multiple mechanically. I would examine revenue growth, gross margins, customer retention, unit economics, and the path to profitability, then use revenue or gross profit multiples from comparable companies with similar growth and business models. A DCF can still work, but assumptions around margin expansion and cash burn require careful sensitivity analysis. I would also distinguish temporary investment losses from structurally weak economics before selecting valuation benchmarks. Discuss revenue multiples, gross profit or contribution metrics, cohort economics, comparable growth businesses, DCF assumptions, and the importance of normalization. Avoid claiming that a single multiple works universally. Question 10. What makes a strong comparable company set? A strong comparable set reflects economic similarity, not just the same industry label. I would evaluate products, customers, end markets, revenue model, growth, margins, geography, size, and risk profile. I would prioritize companies that investors actually use as reference points, then explain inclusions and exclusions clearly. The set should be broad enough to provide context but focused enough to avoid distortion. I would also review trading dates and normalize unusual events before interpreting multiples. In your answer, cover business model, end markets, growth, margins, geography, size, capital intensity, and risk. Explain that judgment matters more than maximizing the number of companies included. Question 11. How would rising interest rates affect an M&A valuation? Rising rates typically increase the cost of debt and equity, raising WACC and reducing the present value of future cash flows. They can also compress trading and transaction multiples, especially for long-duration growth companies. On the buyer side, higher interest expense reduces debt capacity and may make transactions less accretive. However, the impact varies. A company with strong cash generation and low leverage may be more resilient than one dependent on refinancing or distant profitability. Be sure to link rates to WACC, debt financing costs, terminal value, buyer purchasing power, and market multiples. Mention that effects differ by leverage, cash generation, duration, and sector characteristics. Question 12. What is working capital, and why does it matter in a transaction? Operating working capital generally includes receivables, inventory, and other operating current assets, less payables and accrued operating liabilities. It matters because changes in working capital affect cash generation and because buyers typically expect a normalized level at closing. If the seller delivers unusually low working capital, the purchase price may be adjusted downward. I would analyze seasonality, revenue growth, accounting policies, and one-time items to determine a fair target rather than relying on a simple historical average. Focus on operating current assets and liabilities, cash conversion, normalized working capital targets, purchase price adjustments, and seasonality. Distinguish working capital from cash and debt in transaction mechanics. Question 13. Describe the typical M&A process from pitch to closing. The process usually begins with strategic analysis, valuation, and preparation of marketing materials. After launching, the advisor manages confidentiality agreements, distributes information, fields indications of interest, and coordinates management presentations. Selected bidders enter diligence and submit final bids, after which the client negotiates price, terms, financing, and definitive documentation. Signing is followed by regulatory and other closing conditions. Throughout, the banker maintains competitive tension, keeps the client informed, and identifies execution risks early. Layout preparation, valuation, marketing, indications, management meetings, diligence, final bids, negotiation, signing, regulatory review, and closing. Emphasize how an advisor manages information flow, competition, and execution risk. Question 14. What is a fairness opinion? A fairness opinion provides a board with an independent financial assessment of whether transaction consideration is fair, from a financial point of view, to the relevant shareholders. The analysis may include comparable companies, precedent transactions, DCF, premiums paid, and other valuation methods. It supports the board's fiduciary process but is not a recommendation, solvency opinion, or assurance that the price represents a particular intrinsic value. Its conclusions depend on assumptions, information provided, and market conditions. Explain its independent financial perspective, valuation methodologies, transaction consideration, board fiduciary process, and limitations. Clarify that it is not a recommendation, solvency opinion, or guarantee of value. Question 15. Tell me about a time you worked under pressure with an imperfect dataset. In an internship, I had to analyze a company dataset with inconsistent labels and missing monthly entries before a senior review. I first documented the gaps, standardized the categories, and separated verified figures from estimates. I then reconciled key totals to source statements and flagged assumptions clearly rather than presenting false precision. I delivered the analysis on time, and the senior team used it in the meeting. The experience reinforced that transparent judgment and quality control matter under tight deadlines. Use a concise star structure. Explain how you prioritized accuracy in deadlines, describe validation steps, and quantify the result. Emphasize communication, judgment, and ownership rather than blaming missing information. Question 16. Describe a time you made a mistake and how you handled it. I once used an outdated assumption in a project model because I failed to confirm which version was final. I noticed the inconsistency during a reasonableness check, immediately told the project lead, corrected the model, and explained the impact on the conclusion. Afterward, I created a simple version control checklist requiring source dates, ownership, and sign-off before circulation. The mistake taught me that strong analysts do not hide errors, they surface them quickly and build processes that reduce recurrence. Be honest without choosing a catastrophic error, explain how you identified and corrected it, take responsibility, and show the control you implemented afterward. Connect the lesson to banking's detail-sensitive workflow. Question 17. How would you advise a founder deciding between selling the company and raising growth capital? I would begin by understanding the founder's priorities: liquidity, control, growth ambition, risk tolerance, and desired timeline. A sale may maximize immediate certainty and provide strategic resources, but it usually transfers control and future upside. Growth capital can fund expansion while preserving ownership, though it creates dilution, governance obligations, and execution risk. I would compare after-tax proceeds, realistic valuation, financing needs, and potential partners, then frame alternatives clearly so the founder can make an informed decision. Discuss objectives, control, liquidity, dilution, risk, valuation, capital needs, strategic fit, and timing. Show that advice begins with understanding the founder's priorities rather than automatically favoring the highest headline price. Question 18. What are the main drivers of a merger model? The main drivers are the purchase price, buyer and target earnings, financing mix, interest rates, shares issued, taxes, synergies, and purchase accounting adjustments. I would forecast the combined company's earnings and divide them by pro forma shares to compare EPS with the buyer's standalone EPS. Timing matters because a mid-year close captures only partial benefits. I would run sensitivities on price, synergies, rates, and financing because a small assumption change can materially alter accretion. In your answer, cover purchase price, financing, share issuance, synergies, standalone earnings, taxes, purchase accounting, debt paydown, and closing timing. Explain how assumptions determine accretion or dilution. Question 19. How would you evaluate whether a transaction creates value? I would ask whether the present value of incremental cash flows, including realistic synergies, exceeds the purchase price and transaction costs. That requires testing the target's standalone value, financing effects, integration costs, timing, and probability of realizing benefits. EPS accretion alone is insufficient because accounting treatment or cheap financing can make a deal look attractive without creating economic value. I would compare expected returns with the buyer's cost of capital and identify downside cases before reaching a conclusion. Focus on purchase price versus intrinsic value, synergy realization, cost of capital, strategic benefits, integration risk, and returns on invested capital. Distinguish accounting accretion from genuine economic value creation. Question 20. What questions would you ask us at the end of a Piper Sandler interview? I would ask how analysts are staffed across pitches and live transactions, and what distinguishes analysts who earn the most responsibility. I would also ask about feedback cadence, formal training, and how junior bankers gain exposure to senior clients. Given Piper Sandler's sector-oriented platform, I might ask how teams collaborate across industry groups when a transaction spans multiple areas. Finally, I would invite the interviewer to share what has made the firm a strong place to develop professionally. Prepare thoughtful questions about analyst development, team staffing, sector exposure, feedback, transaction responsibility, and firm culture. Avoid questions answered on the website or focusing primarily on hours, pay, or vacation. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.